One man developed a way to strip away market noise and see the literal value of a business. He only arrived at that clarity after a market collapse took everything he owned. You might know his most famous student, Warren Buffett. Benjamin Graham pioneered the math of arbitrage and value investing, yet he became a victim of the exact market irrationality he tried to map. Measured, the bedrock rules of modern rational investing were forged directly from his catastrophic personal failure. Look at the sheer momentum of the 1920s bull market. During this period of dazzling prosperity, asset values became irrelevant. The public bought into the idea that a stock's worth depended entirely on what it might earn in some speculative distant future. Graham rode this wave. He launched his joint account and quickly swelled the capital to $2.5 million, moving his family into the palatial Beresford duplex. He operated under a highly unusual contract. He took no salary. Instead, he earned up to 50% of the profits, with one major catch. He had to personally make up all losses before he could receive another dime in compensation. Going into 1929, Graham carried millions in leveraged and outright long positions. He ignored the flashing warning signs of an overheated market, pouring his energy into public financial battles to mask the private grief of losing his 8-year-old son to meningitis. Soberly, Graham entered the final months of the decade on a collision course. He was operating on high leverage while legally bound to a contract that made him personally responsible for every dollar his investors lost. In October 1929, the market shattered. During the initial shock, Graham survived relatively well, but then he made a critical decision. He held on. He believed his specific, meticulously chosen stocks were insulated from the broader disaster. He was wrong. Look at this ticker machine from the era, buried in a cascade of sell orders. Over the next 3 years, the Dow Jones Industrial Average lost 87% of its value. Graham's joint account surrendered a staggering 70%. This is the consequence of pricing a portfolio based on an unpredictable future. When the economy stalls, the valuation model collapses. By 1932, the national unemployment rate topped 25%. Graham was forced out of his luxury apartment and stripped of his personal fortune. The brutal reality of his compensation agreement took effect. With the fund plummeting from $2.5 million to just $375,000, he was deep in the red. He was legally bound to manage the decimated fund for free until every dollar of his investors' losses was repaid. Meanwhile, he still had a wife, 3 children, and a widowed mother to support. This grueling, unpaid debt forced him to abandon speculation forever. He needed a way to invest that didn't rely on luck or market timing. Graham took a job teaching here at Columbia University while managing his investors' decimated accounts without pay. Working with David Dodd, he wrote Security Analysis. It was a direct intellectual rebellion against the unchecked speculation of the 1920s. This shows their core concept, intrinsic value. Graham calculated a business's hard, verifiable assets, represented by this solid block. The fluctuating line represents the stock price. During panic or euphoria, price moves on emotion, entirely disconnected from actual value. Intrinsic value provided a strict mathematical anchor to hold onto when the market became entirely unhinged. But knowing the value was only half the battle. Graham needed a fail-safe against human error and unforeseeable disasters. He called it the margin of safety. This illustrates the mechanism. An investor demands a massive discount, placing their purchase price significantly below the calculated intrinsic value. If the business suffers unexpected losses and the intrinsic value drops, that gap acts as a shock absorber. The purchase price remains protected. Demanding this discount is the price an investor pays to survive a market crash. Graham spent 5 years working under these punishing conditions. Then, by the end of 1935, a brief entry appeared in his memoirs. All depression losses are made good. He had restored every dollar, without taking a cent in pay. The ordeal left permanent emotional scars. He abandoned his desires for yachts and luxury, choosing to live a quiet life as a classic scholar. His hard-won rules survived the Depression. They were passed to a new generation at Columbia, most notably to Warren Buffett, who used them to build the modern era's most successful investment firm. Benjamin Graham's true legacy shifted away from personal wealth accumulation. He formulated a protective blueprint meant to ensure others would never face the ruin he did. Graham eventually recognized the market as a voting machine, an endless tally of human opinions, optimism, and panic. Like this swinging pendulum, prices move on the irrational momentum of the crowd. The market only functions as a weighing machine that records true value once the emotions of the crowd have finally burned themselves out. To survive the voting machine, you cannot play by its rules. You have to rely on cold, rational mathematics. The greatest investment lesson Benjamin Graham left behind was a method for insulating the mind from the crowd.